Every so often, there's a huge inflation scare in the news. Right now, I'm recording this, it's February 2022. It seems like there's tons and tons of headlines predicting that the sky is going to be falling because of inflation. People start to say ridiculous stuff, like bread's going to be $1,000 a loaf before we know it. So I'm going to show you a little trick that I learned to cut through all that noise and tell you if these claims about inflation are totally exaggerated or if they're legit. Before we get to that though, let's just take a look at the history of inflation in the USA. As you can see, there have been some huge spikes up to like 20% a year, and there have even been some periods with negative inflation too. But all in all, it's averaged out to something like 3.5% per year over the last century. So I would just say be wary when anyone tells you that inflation is going to persist at super high levels for many, many years, because looking back at history, it doesn't really seem to work out that way very often. So instead of listening to like Fox Business or CNBC or your crypto trading cousin for advice on this stuff, you can actually ask the collective consciousness of all investors what their outlook on inflation is based on two pieces of publicly available data. That data includes the yields on US Treasury bonds and Treasury inflation protected securities, aka TIPS, which is just another kind of federal bond. So let's explain what those two things are first. A US Treasury bond is basically just a loan that you give the federal government for a fixed term, like 5 years, 10 years, they make them in all different maturities. They have a guaranteed return if they're held to their full maturity date, and that's called their yield, aka their interest rate. That interest rate or yield is determined at an auction. See, the government wants to pay as little interest as it possibly can on these things, so it auctions them off publicly. Whoever's willing to pay the lowest interest rate on a bond wins that bond at the auction. Now, TIPS are just another kind of bond or a loan to the federal government over a fixed term, like 5 or 10 years or whatever. But their return is a little bit more complicated than just a fixed interest rate like regular Treasury bonds. See, for TIPS, there's two parts. Number one, all TIPS increase in value over time at a rate that's exactly equal to inflation. TIPS also have a second part to their return. They have an additional yield that's determined at auction, just like the regular Treasury bonds. These two pieces to the return of TIPS are also guaranteed as long as they're held to maturity, just like regular Treasury bonds. But you can probably guess that the yield part of TIPS, that second part of the return, is usually going to be lower than the yield of an ordinary Treasury bond. Think about it. You get the added bonus of the appreciation equal to inflation with TIPS. So the yield on them needs to be lower to compensate for that, or else everybody would just buy TIPS. In fact, as I record this right now, February 2022, a 5-year Treasury bond yields 1.63%, whereas 5-year TIPS yield negative 1.17%. So you might be thinking, well, why would anyone buy a bond with a negative yield? But remember, TIPS also appreciate at a rate equal to inflation. So people are sometimes willing to accept a negative interest rate or a negative yield on those TIPS, as long as they think that the inflation rate will more than make up for it. Anyway, what we want to focus on is the difference between those two yields, the regular Treasury bonds and the TIPS yields. So let's take that 1.63% yield on an ordinary 5-year Treasury bond right now, and let's subtract the negative yield of a 5-year TIPS bond right now. If you subtract those two numbers, you get 2.8%. And that number is really important. That number is actually what investors predict annual inflation is going to be equal to over the next 5 years. Think about it this way. Through the auction process, investors have agreed that 1.63% is a fair annual yield for a regular 5-year Treasury bond. But now think about TIPS. They've also agreed that if the government compensates them for inflation on top of that yield, they're willing to accept a negative 1.17% yield instead. So that must mean that on average, investors believe that inflation will perfectly make up for that difference, 2.8%. The guy on TV keeps screaming that a loaf of bread is going to be $1,000 by Christmas, but the market actually anticipates that inflation will only be 2.8% per year for the next 5 years. If investors are right, that implies that prices will be 14.8% higher in 5 years. That's far from a doomsday scenario. Actually, it's pretty normal. Now, let's be clear. Market predictions can be completely wrong, but personally, I'd rather trust billions of dollars of investor money than talking heads on TV who get paid for how many eyeballs they can keep glued to screens, wouldn't you? So the next time you're worried about inflation, just take a look at the difference between Treasury bond yields and TIPS bond yields first. You might find out that you're overreacting a little bit. Oh, and if you want to learn how to invest money and retire early so you can travel the world, don't forget to subscribe to our channel. By the way, I definitely oversimplified some of this stuff, so if you want to learn a little bit more, check out these resources as well. I also wrote my own article about inflation and how to beat it with investing, so check that out on my blog. That's tripofolifestyle.com.